Alrighty. Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. First and foremost is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. So I'm pretty sure most of us out there are pretty familiar with how to ask questions for this session. So I'll just leave that slide up there for review in the meantime, but let's go ahead and get right into the good stuff. I myself have a question for Rob. I know earnings have been coming up in a bit better than expected, and the market seems to be on pause. And so I'm curious as to what Rob's thoughts are as to why interest rates are moving up, and it just doesn't seem to make a lot of sense to me. So I'm interested to hear the experts' thoughts, and of course, excited to interact with you all. So thank you for joining us for this live session. At this moment in time, I'll introduce the man of the hour, Mr. Rob Roy. How are we doing tonight, Rob?
Good, Zach. How are you?
Doing well. Best night of the week. Well, listen, Thursday, of course.
Yep. Well, I'm happy to be here and happy to have everyone joining us from the various live streaming services, far more than what I understand. That's why we have Zach here. I did see a couple of the questions pop in, so I thought I would address those in a moment. But first of all, let's take a look at the market. As Zach said, I think most people would agree that earnings have been a little bit better than expected, but we've kind of stalled here the past couple of days. Two very low volatility days, tiny bars, both with dojis. But if we look at the 10-day moving average, we're still above the 10-day moving average. So a little bit of a pause here. One could argue that that's constructive and doesn't mean anything negative at all. So if we break below the 10-day moving average, remember we still have this potential gap to get filled down here around 440, and even a drawback down to 440 doesn't mean that the move to the upside is over. We look at the DMI, we've been looking at this for a while, and it is telling us that the strongest part of the move is over. So, you know, a little less angle to the upside, I guess you'd say, is warranted. The key is if that ADX rolls over and breaks below 40, that changes things. That means the move is over. Right now, it's just telling us the strongest part of the move is over. The fact that the positive directional indicator is moving lower and the negative directional indicator is moving higher is definitely something to keep an eye on. So we still have that potential zigzag extension at 465, and we got awfully close. So the high was 459.44, so we didn't quite make it there yet, but in the neighborhood, if you will, and we can still continue to get there on lower strength. I think with this kind of action, we'd want to see what's going on with volume, and as you would expect, volume is kind of drying up. So we had this big day where we opened at the high and closed at the low. That was on above average volume. Since then, volume has been basically drying up, moving lower as we consolidate. That's not necessarily such a bad thing. You wouldn't want big volume as we back off a little bit, but it certainly is bringing in a little bit of wait and see here. Are we getting ready to start the wave 4 correction, or is this just a sideways consolidation, consolidating this big move to the upside from basically that gap up after July 11th, and then we're going to consolidate and move back to the upside. Here's the fly in the ointment. Zach brought this up at the beginning. There's that 10-year back up above 4%. Why? Why has it moved back to the upside? The interesting thing about this, I think, is the fact that Chairman Powell, now I certainly wouldn't call his comments dovish by any way, shape, or form, but I do think he was slightly less hawkish at the meeting last week than he has been, because he said we're going to look meeting to meeting. And before they had said 2 more rate hikes for sure. And now after this one, so that's one out of the way, he had still committed couple months ago to one more, and now he's saying, well, we'll look meeting to meeting. So he kind of backed off that a little bit. That's why I'm saying he wasn't quite as hawkish, but he didn't say we're done. I think that would have been the dovish statement. But with the fact that rates are moving to the upside, that's kind of interesting. What does that mean? Is it trying to say that the recession is coming, that long-awaited recession that people are saying isn't going to happen, that there's going to be a no landing or soft landing? Is that out of the cards? Or is it just the fact that people view the economy is going to be much stronger than expected and the Fed's going to have to go more than one more time? Either of those scenarios could account for why the 10-year will move back to the upside, but none of them are good for the Qs. None of them are good for tech stocks. Getting them back above that 4% is kind of that key level. So we had gotten just barely above there back on the 27th of July. We came back down, but just barely came back down to the 10-day moving average. Now we're back up. Now, when we broke above it here on the 6th of July, so first week of July, we didn't have any follow through and we broke back down. Are we going to have follow through this time? That would be a whole different scenario. If interest rates break and start to move to the upside, then I think you have to call the entire rally into question, and you would start looking for where money is going to rotate. Money has to move into the market every month through IRAs, 401ks, et cetera, the dollar cost averaging programs. It has to come in, but it moves to more defensive areas when you get interest rates moving to the upside. So when we look at that, we say, that's a little bit of a cause for concern. Well, then we go and look at the dollar, and so much for breaking back below 101. We tried it. It was a vertical move. So just such a great example of why we talk about this is so important. You don't trust vertical moves because they get retraced. So we had a vertical move to the downside, breaking that 101 level, and we've come right back above it. Now, it looked like we were going to test it and then break back below 101. Once again, no follow through. And here we are back above 101. Why is the dollar so strong? Is the Fed going to raise more? Is that going to support the dollar, the fact that interest rates are going to go much higher? Or does it mean that not only are we going to have a recession, but that recession is going to move globally, and the place you want to be is the US dollar as the currency of last resort? Once again, both of those scenarios account for these two things. They're drastically different, though, as far as where the equities market could go from here. One of them could be bullish for the equities. The other one is certainly bearish. So, yeah, a little bit of, things that make you go, that's exactly where we are now, for those of you that are as old school as me regarding music. So pretty interesting that the dollar is moving back to the upside like this. So I think we have to be really, really careful on where we look from here. Looking at the VIX, and the VIX just doesn't want to break that wave 5 low. We've talked about this as well here. Those of you that have been here, TradeFinder week after week, you know what we're talking about. And those of you that are new, that wave 5 is right at the 61.8% fib level, which in my opinion is the strongest of all fib levels. It's going to be very difficult to break that. Plus the wave 4 on the VIX is right at the 38.2, which gives you the forecast of a 61.8% level. So to break below that, we need to go to an extended level to the downside. So far, we haven't done that. The one thing that we have done that makes sense is bounce back up to 17. We broke that level that was support for a couple of months. So we broke it, we came back and tested it, and now we're back hanging around these lows. So something's got to give here. I saw one of the comments that came in talking about how Fitch had downgraded the U.S. debt, and the futures actually opened with a gap down. Not too much, and I know it's what we from 4 o'clock to 6:30 is where you had the draw, and we're down 11. We were down much more than that. We've come back quite a bit. In fact, we've come back 18 points, so we're down nearly 30 when that news came out. But we've rallied back. And is it a buy the dip opportunity on the futures, or are we just filling the gap? We'll know tomorrow. We're not going to find out that answer probably until the market opens tomorrow. But really interesting things going on here, and it makes you wonder, are we starting to see, and this is where my concern is, the first signs of a recession now that everybody is all on board? It seems when you listen to the talking heads that there's not going to be a significant recession. And as soon as everybody goes one way, you know how it works, the market goes the other way. And that's what I have to wonder now, is that what's occurring? So many people have dismissed a significant recession to the point where that may be exactly what happens. We're not there yet. And again, going back to the chart of the SPY, all we've done is have a couple quiet days, consolidating a pretty significant move up from early July. So there's no signal here of anything yet to be concerned about. But, you know, we've been talking for how many months now about cautious optimism. And what I mean by that is you have to trade what the market gives you. And right now, the S&P is in a wave 3 to the upside. You know which stocks are driving it. So you stay involved from that standpoint, but you don't take your eye off the ball. You know all these things that are going on behind the scenes that could cause things to turn rather quickly. So you keep that in mind, and you don't just go willy-nilly into being long, load the boat, back up the truck, all the kind of expressions that we used to talk about going all the way back to 1999, et cetera. That this is not the time to do that. So it's a stock picker's market. Be very, very careful on where you go, and understand that there's some underlying things that historically have not been positive. They haven't come to fruition yet, but they have a pretty good track record in the past. So if we take a look at the rest of our markets, so let's bring up the diamonds, and that's a pretty good indication, I think, of money that is moving into not defensive, but safer pastures, if you will, because the Dow is the 30 largest stocks, as you know, and they're a little bit more of a safe haven than even the S&P 500, even though it's called the blue chip stocks. But then when you get to the Qs, you start to get into a point of a little more risk, and you can see that looks like we're getting ready to take another leg higher here on the DIA. So we had this big run to the upside, just absolutely peppering this wave 5 extension or forecast, the tap box, time and price projection. The software is produced by the Hub organization. You can find out more about it at hubb.com. I actually saw some comments on last week's US market update on the EWO channel on YouTube that were saying that I've never been a believer in Elliott wave, but you've made me one. Well, I haven't really done anything. I'm just showing you the charts. I'm just showing you what the Elliott wave is doing and try to explain it to you in a common sense standpoint, rather than, you know, the really detailed mathematical stuff that if you read Ralph Nelson Elliott's books, it's written like a math teacher would write something, and it's hard to understand. So I'm just trying to do the best I can to make it understandable for traders, and what we can take from this mathematical algorithm and use it in our trading decisions. That's really all I'm trying to do. The algorithm speaks for itself, I think, and the record speaks for itself. But will we break out of the top part of this tap box? You know that when we see that, we want to take a look at the DMI, and how different is that than the S&P. You can see that the ADX is still going up. It hasn't broken above 40 yet, and the positive directional indicator is turned up, the negative's turned down. Completely different scenario of the DMI that we looked at on the SPY. So one thing that you can't argue with is, at this moment in time, things always can change from day to day. They can change in the markets, but at this moment in time, money seems to be transitioning or rotating, if you will, into the Dow rather than the S&P. And then let's take a look at the Qs and see how they did today, with the 10-year going back above 4%. Not as bad as you would have thought. You would have thought that, oh man, we probably had a big down day. Now we have had, and we've talked about this at least last week, maybe not much before that, or maybe it was in the live Q&A. By the way, on Fridays, we do a live Q&A on the Hub Financial channel. But you can see here that we had the ADX moving lower here as we made new highs. That's called divergence. So you see new highs that occurred there on the Qs, and on these two new highs, you had lower highs on the ADX. So that means that last run there that occurred in the middle of June up until the middle of July was nowhere near as strong as the move that occurred going back here from May to the middle of June. That move was pretty strong. The next move, not nearly as strong. When you see that, you have to start to wonder as we continue up into thin air, and I use it as, you know, if a rocket didn't have a further booster, so you have a rocket that goes up in the air and it's got this thick air that it has to go through, and then it goes up and up and up, and then it gets into thin air. And if we don't have that secondary engine to propel it into orbit, the rocket will turn and fall back down as it gets into that thin air. That's what's happening. You know, I love analogies. Those of you that have been watching, I have all my old school analogies that I like to use. I've used that one for a long time when you have scenarios like this. And so we have to wonder, are we falling back down to earth in the market? We don't know that yet, but we have enough signs to make us be concerned and wonder if that's going to happen. And it just, again, keeps that caution in the phrase cautious optimism. So not nearly as bad as you might have thought, not as bad as I would have thought things would have been on the Qs today, but we can't argue with the fact that that ADX keeps going lower and it's still above, even though it's broken down. It's down below 40. It tried to break back above it. It couldn't do it. And the positive directional indicator is lower than the ADX. The negative directional indicator is moving up. It's telling you the sellers are feeling a little more empowered. Okay. They are getting a bit better, a bit stronger along those lines. And if you want to look at the CCI for something a bit more short term, remember the DMI is like not quite as this bad, but it's like a big, you know, aircraft carrier that is having to turn in the ocean and takes forever for it to turn. We look at the CCI for more of day to day. It's more receptive to what happens. Now, the two directional indicators of the DMI, they're pretty receptive day to day. The ADX is not. The ADX is definitely a lagging indicator, but the CCI is very volatile, moving with the day-to-day movements. And we came back up. We got to an extreme point high. You can see that in the middle of July, corresponding with that high. So it makes sense that this move back down coincides with the CCI moving down. Once again, I would point out the divergence. So we bounced back to the upside, but we really had very little bounce out of the CCI. So I don't think the fact that this, you know, movement in the Qs got almost back to those highs. We just had a little blip on the radar screen with the CCI. And usually when you break from an extreme point high and you get below 100, it normally means you're going back to zero. Then you have to reevaluate. So we're not at zero yet. So it would imply that perhaps there's a little more weakness to come before we decide, are we going to get bearish? So that's what the CCI is telling us right now. And we'll figure that out over the next few trading days. And another indication of risk on, risk off, we've got a couple of them coming up here, is the IWM. Now, this gives you a totally different story of everything we just talked about. So we've been talking about how the SPY looks a little weak. The Qs look shaky. The Dow looks pretty darn good, which would lead you to believe that money is leaving riskier equities and moving to more stable equities. Well, if that is the scenario that's playing out, you would think the IWM, the small caps, which are viewed by most as the riskiest, not risky, but riskiest of the SPY, DIA, and the Qs, you add in the IWM, you would have thought, oh, that must have been a really ugly day in the small caps. No, it wasn't. We came down and hit the 10-day moving average on the low. It looks just as strong as the Dow. So tell me how to figure out what's going on right now. I saw some commentary. Actually, somebody wrote this in on a support question that knows a lot of money managers, and they were saying how they were getting a consensus from, I don't want to tell you who it is, but they were getting a consensus from money managers that this is one of the more difficult markets over the last year or two. I would extend that out to 3 years, but they said the last year or two that they've ever seen. And so when we go through, everything made sense up till right now, as far as looking at the SPY, the Dow, and the Qs. All that right in tune. You know, you got interest rates moving up, concern, dollar getting stronger, why? And so then you would think all that would play into, gosh, this was probably a big down day on the IWM. And it wasn't. It was actually, it wasn't an up day, but we had a nice day where we came down and hit the 10-day moving average and bounced off of it. And we are trying really hard to move up to test that 200 level. And you have to wonder, when are we going to test 190? I would have thought today would have been a perfect scenario to break back down, because I did talk about that over the weekend, that with this break above 190, the 170 to 190 level had been the trading range for over a year. We did tighten it up, as you know, you've been watching, between 170 and 180, but we broke above that in early June, came back and tested it in mid-June, then we broke above 190. So now we have to wonder if we're going back a couple years to the range, the old range, which was between 190 and 210. That was the trading range going back a couple years ago. We got to test 190. You can't just break a major point of resistance and then take off. That usually doesn't happen. So I would have thought today's a perfect opportunity to come back down and test that. And let's find out where the risk tolerances really are. But it didn't work that way. So a very confounding day, I think, is the analysis that I would give on what's going on today. Mixed signals. And we talk about conundrums. I've talked about them several times over the years, when things don't make sense because there's correlations that exist in the market that have existed between the equities and the bond market, between metals and the dollar. There's several different correlations that we can talk about, and they sometimes get out of whack, but they usually don't stay out of whack for long. And then usually things move into the correlations as they should exist. Well, right now we're in one of those conundrums, using Greenspan's term, of it doesn't really make sense what happened today. So, it will work itself out. Things will, everything will be all right with the world again. But it's confusing right now. And I think when the world is confusing, it's hands off. Wait until the market tells us where we're going to go. Maybe we're getting ready to start a corrective move, or maybe we're just consolidating and the IWM is telling us, the riskier of the four markets we look at, that, hey, all's good and we're getting ready to turn back and move to the upside. But some people are concerned because of the movement into the Dow. So what all is going on there? I don't know. All I'm doing is sharing with you what I see. And when things like this occur, this is when I get not just cautiously optimistic, but cautious, period. Looking at Bitcoin, and that halving is coming. First quarter of next year. We've been talking about this for, gosh, I don't know how many weeks, on how we need to hold 29,000. And look what happened today. And I know those of you that are new, I know it trades 24/7. I know all that. But it does give a print just like the futures do. So for software like this, where we're looking at end of day charting, we have a print to look at. And you can see that we broke below it, but we closed back above it. So for the time being, we're back above the 29,000, but we dipped our toes in the water of breaking below it. And I just don't see much to stop it. If we break below 29,000, it looks like 27 at least is next. And you could make an argument that if we're going to go that far, then we may be coming all the way back down here to test that previous wave 3, which was tested once. It was tested in the middle of June. So we already tested it and took off. We don't have to do it again. I'm just saying that if we come down to 27,000, we have to keep that in mind as a possibility. It may not. We may come down, test 27,000, bounce and take off. But if you're bullish, the more bullish scenario is that we've had all this consolidation. All right, a little bit of give back. That's okay, because we had this vertical move. And usually when you have a vertical move, it comes back down at least halfway. So is that enough? Is that what we did today? And we're going to hold and take off? But we need to hold 29,000 if you're long Bitcoin. If not, you need to have the stomach for the fact that you're probably going to 27,000 if we don't hold 29. That's very likely where we're going to be. And then we'll have to reevaluate and see. So danger, danger, Will Robinson here on Bitcoin as well. So, from happy where we've been for the past few weeks to the point where, all right, back to reality. We've got some things to be concerned about. There's an old adage, the market climbs a wall of worry. Well, we got enough to climb, the Great Wall of China right now. And we'll see how all this plays out over the next couple of days. That Fitch downgrade, you go from AAA to AA plus is, we all know the debt to GDP is, I've showed you the chart before. The debt to GDP is over 120, which basically means we're living on credit cards here in the US, not just individuals. The country itself is living on credit cards, and they're over 20% interest rate cards. So these aren't cheap credit cards. What took them so long is the way I would look at that. When your debt to GDP is over 120, I think it should have been downgraded a long time ago. So I don't think that's that big a deal, other than it seemed to, put a little bit of a shock into the futures. But as I said, we're recovering from that, or at least trying to, and then we'll see if we recover all of it by the time we open tomorrow. So, wow. You ask a very basic question, Zach, and just gave you a really extended, complicated answer, but that's where we are. We're pretty complicated with where things are in the market. Now let's look at the Aussie market. What's going on here, 22 to 23, and we just cannot seem to put any distance between the EWA and 23. Every time we try, we get turned back, and now we're broken back below 23. One day means nothing. That. We have to have follow through. So do we get a confirmation day? Are we going back down to 22, or are we going to turn back and break back above it? But unfortunate that we couldn't get above this 23.5 level, because you can see all the resistance there. If we can just break above 23.5, there's literally nothing to stop us from going up to those highs that occurred back in January on the EWA. But we haven't been able to do it. If we can, then literally there's nothing there. That was a quick move lower. There's no resistance. This will be an easy move up here, but the shorts aren't giving up the ghost. So we come up here and they press on the gas and are able, at least so far, to push things back down. Does that mean that the bulls have weakened to the point where there's not enough oomph to make the shorts cover? We'll see how that plays out. So let's take a look at the Canadian market. The EWC normally works kind of along the lines of what we do here in the US. And you can see that, man, right there at 36, and we backed off. It doesn't look so bad, though. That's a resistance area, but it does look pretty similar to what's going on in the EWA, doesn't it? We've got a level, not the same level, not the exact same charts, but we have resistance levels that we can't get through. And on the EWC, we need to break above 36. If we can break above 36, holy cow, you could have a heck of a run, and movements to the upside, impulses moves, new impulses moves are likely often started by short covering. And there's a lot of shorts, I promise you, at this 36 level on the EWC. And if we can break above it with follow through, which we have not been able to do, we tried yesterday, but we couldn't do it. But if we can break above it with follow through, those shorts have to cover, and you'll have a heck of a sprint to the upside in the EWC, but it has to get above 36. And since it hasn't, now you got to be concerned with, man, are we going to come all the way back down to 34 again, which is where support is, and oh, by the way, where the wave 4 tap box is. And for those of you that are newer, this 4 here, tap box, does not mean, hey, the wave 4 started. It's not saying, the algorithm is not saying the wave 4 is underway. The algorithm is saying if the wave 4 were to begin today, that's where you could expect support. And the fact that it coincides with just natural support from lows, gives it a little bit more fodder in my opinion. So let's see if we can't get above 36. Maybe by the time we talk to our insiders on Thursday night, we've blown back to the upside. The market's done consolidating. The IWM was the one that was right out of all this. And we were just taking a breather, which the market needs to do from time to time, and we're off to the races again. Maybe that's what happens. I'm just saying that there's enough to worry about, that don't just assume that's going to be the case. The whole moniker about that word assume. So we don't want to fall into that mix. Now let's take a look at the INDA. Bothers me here is it's been on the headlines on financial online now, not magazines anymore, but that the Indian market has been performing so well this year. It has been performing extremely well, but you hate to see those kind of headlines. We used to talk about when something would appear on the cover of a magazine, like gold. Let's say, gold's rallying, and then when it would show up on a magazine, you got to buy gold, gold's off to the races or whatever, that's normally marking a top. So when you start to see a headline that the India market has been, performing so extremely well this year, one of the best performing markets of the year, all that stuff is true. But once it makes it into the mainstream, that's when you have to start wondering, is it time to maybe take a pause there? We're still above the 10-day moving average. We're still in a wave 3. It still looks pretty good from there. We look at the DMI though, we're not there yet, but we're about to break below 40 on the ADX. And if that happens, then I can tell you that that move is done. And we're probably heading down for the wave 4 correction. We're not there yet, but it looks suspect with the ADX moving lower, about to break below 40. The positive directional indicator is lower than it and going down. The negative directional indicator is moving up. All that is giving you, if not a red flag, flashing yellow caution signs to be very, very careful there on the INDA. If you've had a great run and made that, then maybe it's time to take some off the table. We should probably stop showing the EWG because gosh, it's been the entire year that we've been in this really tight range here between 28 and 29. And I'm just a broken record saying the same thing. If you break above 29 with follow through, in this case, we have to do more than that. We actually have to break this wave 5 high with follow through. Then we could be off to the races to the upside, like the Canadian market breaking above 36. But if we don't, and we come down here and we don't hold 28, well, then we're looking at maybe coming all the way down to this previous 4, back down to 25 or so, which wouldn't feel too good. So really tight range here in the EWG. Nice run it had. It was fun talking about it after it had been acting horribly for a couple years, and then turned around, did really well. Now it's done absolutely nothing for 9 months now. Well, I can give it January. Okay, so 6 or 7 months has done absolutely nothing with that range between 28 and 29. So pretty cautious through there. I would like to show you something, and this is really interesting, going back to the dollar. We've been talking about how much we want to get involved in the metals, SLV or GLD, chomping at the bit to go long there. We resisted the urge. I said that if the dollar broke below 101 with follow through, you'd catch a bid in the metals, and maybe that would be a signal to trade them. But also backed off because the break below 101 was vertical, and we didn't do it. We didn't bite that. We didn't go for the head fake, knowing that we were likely going to retrace it. It was interesting a few days ago when we came up to 101, tested it, and looked like we're coming back down, but now we've broken back above it. But for our alert subscribers, what we did do is send out a directional trade on CMC, which is commercial metals. It was a short-term trade, and we did take advantage of when we had that little bit of a move lower, and you can see how the metals coincided. You get that big breakdown in the dollar, you get a move bit to the upside in the metals. So we've set up with a zigzag here, call it the 38.2% corrective level. We're going to go up to the 61.8% extended level, which is exactly what happened. That's what you look for. Boom, we got there. That was the plan. So the zigzag did exactly what it was supposed to do. We took the trade off. It wasn't any sort of a huge winner, but 36% in 10 days on, really catching the only opportunity to go long in this space. That part I think was pretty good. That was pretty cool. But, it's not there now. And we did the right thing by getting out when we hit that 61.8% level, because you've seen what's happened to the dollar since then. And by the way, this is what the alert screen looks like at ewotrader.com for our alert subscribers, where we send out, you can see alerts for entries, any adjustments if needed, and exits. And so we kind of guide you from beginning to end on positions, where here at TradeFinder, we give you case study considerations, and then you're on your own to pick the strategy, figure out when you want to get in, when you want to get out, etc. We just identify opportunities here. So the difference between that and the alert service at ewotrader.com is the fact that we send out actual alerts to you through text and email. So anyway, we caught that quick trade, and now we're just going to wait and see. Love to get back into the metals, but until we break back below 101 with follow through and not in a vertical nature, we just have to wait. So I want to get into SLV. I want to get into GLD. The opportunities aren't there yet. Maybe they'll come up. All right, so let's look at some of our past case study considerations here that we've done in TradeFinder. We only have a couple. Everything else has been closed out. So if you've been following along, we've had one heck of a run here with our case studies. And you can go back. All these are posted going back years. You can go back and check our track record for yourself. If you want to go back and do the research, all the recordings are there. You can see the case study considerations that we've identified. So we had MTB back on the 18th, expecting it to move to the upside a bit. Our target was 140, and you can see we did go to 140, and we haven't gone past that, but it was a small trade. So just moving from where we were to 140, we usually like to see a 10% move. It wasn't a 10% move, but 140 was our target. So you got to call that one a winner. So if you were following along with the game plan, where we tried to tell you where the target was, then you would have exited. And then on WSM, Williams-Sonoma, like that one because of the ties in with the housing market. And gosh, MTH was on the search from last night. But you can see here, we were looking for another move to 140, and bam, right to 140. So small moves, but this is what you want to do. This is the type of trading you want to do when you have a market like this. Take short-term opportunities. This is not a time to be putting on, well, depending on what, if you're looking at China or whatever, I think you can do some longer term stuff there. But if you're just looking for places to do longer term positions here, I don't think this is the time for it. Let's see if we get a shakeout from a correction. But both those trades had the same target of 140. Both of them hit it. So they did what they're supposed to do, which means we have now no open case study considerations from TradeFinder. Everything has worked well. And so the piece of paper, and I'm old school, I write stuff down, is completely broken off. So we're going to have a quick course, I think, next week, because we won't have a whole lot to talk about other than whatever's occurring in the market. Well, let's see if we can find a case study consideration for tonight. There are 4 on my impulse search. And by the way, Again, this software from the Hub organization. If you are an alert subscriber at ewotrader.com and you have this software, you get these searches that say EWO, and those are mine. The cool thing about this software is you can program your own searches. If you have your own criteria, your own indicators that you like that work together, you can put them together and create your own search, look at your results, go back test, see how they would have done over time. It gives you every opportunity to create some sort of a technical analysis system that you have confidence in. So you also get these, so our subscribers can see exactly what I'm looking at every day. So we have community bank. That's interesting. MTH did move off, but that one was on yesterday. We can take a look at it. Wow. You know, gosh, that was pretty good volume bar there. We're a little to the upside there on the CCI, but that's an awfully good looking DMI, the ADX curling up, and the wave 5 finish. The problem is our target is right there and we're almost there. So when you have a wave 5 that ends, if the wave 5 doesn't extend more than 100%, for those of you that may be newer, then what happens is the wave 5 pattern ends, you retrace to the previous 4. Now, if the wave 5 extends more than 100%, different rules. But if it's less than that, you go back to the previous 4. And it's done that in very short order. Now, the DMI would be suggestive that we're not done, that we're going to continue to move higher. And it's awfully tempting because there is a lot of resistance there at 60, but there's resistance here at 56 too. So if we can break through 56, I do think we go to 60. But that's where the wave 4 is, right here, and that could be it. Even though the DMI is suggesting, man, there was a lot of strength in this move. More strength than you would have thought if it was just end of a wave 5, bounce back to the previous 4. It looks like it wants to continue up to 60, and maybe it will, but let's see what else we have. MSC Industrial. That one, is that DMI? It's another big volume bar. See, the way I set this search up, the ADX has to break above 20, but I've set the search up to give me results as the ADX is moving up, but before it gets to 20, so that I can look ahead of time. Because if you just set it up to where the ADX is above 20, you're going to get readings where the ADX is 30, 35, whatever, and the majority of the move is over. I would rather see some opportunities, like perhaps this one, where you can catch it right when the ADX breaks above 20, and you can get a little bit a stronger part of the move. It does look like this one wants to go higher, but without that ADX triggering above 20, that has to go on a watch list for me. So let's look at Accenture. And it almost looks like a triangle there, but the ADX is too high. If we had a lower ADX, I would say, well, that's what a great strangle opportunity that is with this triangle formation. And if you've been watching long enough, you know that regardless of the fact that it's shown up on a directional search, the triangle takes precedent. But I would not look to get in this as a triangle because the ADX is too high. And what that's suggesting is that we could possibly consolidate longer. You don't have to. You don't have to have a low ADX to break out of a triangle. So it could break out any time, but I can't do that one. Staying disciplined to our rules. And so site 1, now this is one that's been pretty ugly, and it had some sort of a move to the upside here today, and you know, maybe this is the answer. We've broken above resistance there. The CCI is moving up. Let's see where this might be. This might be our winner here, the last one. Yeah, the ADX came down. Now this is the only negative that I see here, is I would have preferred when this ADX came down that it broke below 20 and then turned back to the upside. It's just usually a little bit stronger of a signal. It didn't do that, but it is turning up, and we're getting separation from the 2 directional indicators. So this week's case study consideration, for 8-1, it'll be the only one we have to look at next week. All the other ones have closed out. It's been a long time since we've had no open case study considerations, or what you would consider open. But let's look at this and see if we can break above 175 there. If we do, then we're off to the races there. This could be something that looks really good. It's not that overbought. We were very close to the 10-day moving average on the low. We have a tiny bit of resistance here, no doubt about that. So perhaps it goes sideways for a day or two. But if it doesn't break back below 170, that would be the only thing that would change things for me. A break below 170, then I would want to wait and let it get back above that. But any sort of pullback tomorrow, as long as it holds above 170, I think this is has some potential to move higher. So with that, Zach, I'll open it up to some questions.
Yeah, definitely keep an eye on that one. Thanks, Rob. Yeah, no, great presentation per usual. And I just want to first off say for everyone out there that's watching, joined us live, if you feel the same, please smash that like button for us. It goes a long way, and we do appreciate it. So we'll start out. We're going to talk about the Fitch downgrade, but you kind of covered that, I'd say, pretty well. You don't see there being a major impact. I guess if you had any closing notes on if there'd be a gap down in the SPY tomorrow, possibly.
Well, there was a gap down in the futures, but it's recovered quite a bit. But, you know, it could just be filling the gap, and then we move lower. So we're only down 9 now on the futures, which is considerably lower, almost 20 points lower, exactly 20 points lower. So we were down 30 on the open, and we're only down 9 now. So we recovered 21 points on the futures. And, you know, there's a long time between now and when the market opens. But yeah, going from AAA to AA plus is just, you know, it's just like a, you know, a flick on the ear of, hey, you know, pay attention. As I said, I think it should have occurred a long time ago. You know,
overdue. Yeah, exactly.
So, no, I don't think it's going to be any sort of it may get talked about a lot. You know, maybe we get another pullback day tomorrow. I don't think it's anything that's going to be really ugly. I could be wrong. But at least the way the futures are acting, they use it as a buying opportunity so far. We'll find out when they go back and fill that gap.
Yep, I was going to say, we'll certainly find out, won't we? So let's go over to BABA.
Yeah, you know, it's funny that was asked, because I almost brought this one up on my own. This is what caused me to hesitate when I said I don't think this is a time to put on longer term positions. This is more of an opportunity to take short-term moves, get in, get out. But I do think the China market is looking a lot more interesting than where it was before. And Alibaba broke above 100. It came back down. It's testing it. It's holding it. The issue here is the wave 5 ended, didn't extend 100%. So it's supposed to go back to the previous 4. So it's done that. So is that it? I think on this one, if you do have a high risk tolerance, and you want to put on more of a speculative trade, I think you could jump in here with the opportunity that BABA runs from 100 to 120. And I think the fundamentals support that. Things are looking a bit better in China. The government has backed off for now. You know, they can show up with more regulations anytime. But for now, they seem to be softening their stance on things. We held pretty well at 80. And we've made that run to 100. And I would submit that we could consolidate here at 100 and then make another run to 120. So I do like this one. If you have, you know, a good stomach, and then you also have a little more of a time horizon, I don't necessarily think it's going to, you know, vault up to 120, but that is a place that I would look. I actually looked at that one myself earlier today. So whoever asked that's reading my mind. But yeah, awesome question. I think that China is a place that you can look. NEO has caught a bid. NEO's back in the world of moving to the upside again. So yeah, I think China is a place that you could rotate some money right now.
Absolutely. And switching sectors here, what are your thoughts on Disney and all the news that's been
Oh my goodness.
around that?
Poor old Disney. The only positive I can say about Disney is it's held what it needed to hold. I saw it come down here. I think we've talked about this several times. It comes up a lot on the Friday Q&A that it needs to hold 85. So far it has. It's been able to do it, but Disney has a lot going on, not just the war with the governor of Florida, but the strike, the Hollywood strike on creating content, and the whole political thing. Living here in Central Florida, the word is the lines aren't long at Disney World, like 20 minutes. You don't even need a fast pass to get on a number of rides. What's that going to look like on their next quarter? Can they still hold? I just wouldn't touch this with a 10-foot pole. It does look impressive that it's held 85. If it can break above 90, you might have a really quick trade. When is the next earnings report? Let's see if it'll show up here. Oh, yeah, now for scratch what I just said. Yeah, you might have a week here where it's got a doji today, though, so who knows what's going to happen when it opens tomorrow. If it can break above 90, you might have a quick trade to 95 is what I was going to say. But I would not be long going into this earnings report. I don't know that 85 holds after that, unless they, figured out some sort of way to make the earnings look rosy. It looks to me like those bushes that they have in front of Disney that are all shaped like characters. You're going to have one shaped like a downside arrow here. When the earnings comes out, it's going to be really interesting to see. So seeing that the earnings is just on the horizon, I take back what I said. I thought you might have an opportunity for a quick trade, 85 to 90. If it can break above 90 and they find a way to gloss over everything that's going on, yeah, it probably runs to 95 and maybe even fills a gap up near 100. But it could just as easily break 85 and then it's watch out below then. So.
Yep, absolutely. It's going to be interesting to watch how future plays out for that stock.
Yeah.
One to keep on the radar. Anyhow, we're going to go over to a question from Julie. I'd like Rob's thoughts on Dish. The charts indicators look poised for a bounce up. They've recently entered a partnership with Amazon to provide wireless services to Amazon Prime members, and they announce earnings before the bell tomorrow, August 2nd.
What's the symbol?
Dish, D-I-S-H.
Oh, Dish. I thought you said ditch. And I was like, I don't know what that is. Yeah, they are trying. I mean, you got to give them credit. And you can see how ugly it's been since they broke below support there at 14. And they came down here and they had to get down towards the 5 level before anybody came in and supported them. And there you can see where, a little bit of volume came in finally down here as they got to 6. And people are like, we don't want to see it go to 5. So there's, and it's hardly moved it, which has to be really frustrating for the institutions. But they're trying, and maybe they can. It's not a bad. If you're looking for something, well, it's before the market opens, so there's nothing you can do now, unless you're buying a stock in after hours market. But it's there. Here's the trading range: 6 to 8. If it can break above 8, then it might take off and run. But if it has a decent or better than expected earnings report, it may gap up, and all that move is already done. So it's going to be hard to take advantage of this. But if it breaks above 8, it could really run. If it comes back down, again, the institutions supported it here, going back to May, into May, June, July. Institutions have been buying, trying to hold that level there at 6. Perhaps they step in again. Let's see what it says. Maybe that deal has paid off for them, or they can spin it to where, regardless of what their earnings report looks like, they can create some optimism for future, because looking ahead matters as much as what the earnings are when these companies make their reports. So we'll see. it's 6 and 8 is the range. Above 8, you could have an upside trade if it doesn't gap up a couple dollars. But if it doesn't get above 8, it's probably coming back down to 6, and then we'll see if the institutions step in again. If with that news, perhaps they're going to have some patience with it and come in and buy more. So if you could get it back down to 6, it might be a good buying opportunity.
Well, with the continued uncertainty, let's go ahead and pivot over to crypto. You covered Bitcoin in depth there, but I think there's going to be continued interest in coin for future sessions.
Can't imagine that. Coin is the one that's been asked about, and you've heard me time after time after time talking about don't like these vertical moves. I said, I think last week, if not last week, the week before, that if you could get it back down to 80, that would be a great buying opportunity. And I still stand by that. I wasn't sure it was going to do that last week. We did come down, and it looked like we were trying to hold here on the 10-day moving average. We've broken below that. We did close much higher than the low of the day. With earnings coming up, I don't know if you're going to get that 80. Gosh, this is a tough one, right? Because the earnings report could be good and it could really explode, or it could be not so good and we could see 80 again. I think, it's a really, if you have just total, reckless abandon type money, and you're looking for something that could generate a nice reward, if you go long coin and anything of any sort of positive news comes out, it could take off on earnings. Or you could wait, be more conservative, and you might get an opportunity to buy it back down at 80 again. So this one I usually give, if you're aggressive minded, you could look at a speculative trade now. If you're conservative, wait. You'd have to be, really, really aggressive to take a shot now in front of that earnings report. But I think 80 has a great chance of holding. If it doesn't, it's going to 60. But let's see if it can hold 80 here and set itself up for that run along Bitcoin if it does do what it's done in the past with these halvings that come up periodically.
Yes, indeed. All right. I see we are at a minute after the hour. So do you got time for one more question, Mr. Roy?
Absolutely. Right. Let's do one more.
So there's tons and tons of great questions remaining. And as most of you are out there are aware, we only have the hour for this session. So we'll never get through all of the questions. Please know it has nothing to do with the validity of the question. We just only have so much time. So if we didn't get to yours tonight, please attend the insiders meeting when there's a 45-minute Q&A portion, and obviously a much higher likelihood of getting your question addressed there. So tonight, let's end on a note of AI, as we have our time strategy. And this is obviously of major relevance in today's world, just using the word AI. So figured we'd go over to ANET, A-N-E-T, to wrap up tonight's session.
Okay. I actually thought you were going to give me the symbol AI. I was about to type it in. So we will take a look here. I haven't looked at this one recently, but yeah. And after hours today, what was the stock that AMD AMD popped after hours today as well, and their earnings report was pretty darn average, but they mentioned AI, and the stock was up $5 after hours, and would not have been if it hadn't been for that, in no way, shape, or form. And so we're still in kind of that, .com E or I, like we were back in 1999. If you come out and you say anything regarding AI, there's money to come into your stock. But you probably already know what I'm going to say about this one. You went vertically up, you gapped up on the earnings in the news, and if you got an opportunity to get it back down to test this area where the previous wave 3 was, I don't know that we're going to come all the way back down and fill that gap for a while. So if you're able to get just down here around 175 or so, then I think there's no way I can chase it now. But if you get a bit of a pullback, then perhaps you have an opportunity there. The 10-day moving average is even below that, but I don't know that we give up the wave 3 high. So it may get some follow through tomorrow to the upside again, but I can't go long moves like that unless there's some sort of back to reality move, and let this play out and let it come back down towards this 175 range. And if it does that, then I think you can go long. But yeah, AMD was a perfect example. Very ordinary earnings report, other than the fact that they started talking about their AI stuff too, and that made the stock pop. So we're still in that mode. So you want to do research and find out what companies are working on their AI platforms and about to report earnings. That's where you can get some of these crazy pops. But other than that, it's a pretty challenging market. Hope you all had a great weekend. Thank you so much for spending some time with us tonight. We appreciate it very much. As Zach said, if you like it, please hit that like button. You know how the algo works, and it's appreciated. And give more people the opportunity to visit with us on Tuesday nights. So thanks, everybody. Have a great rest of your week. Look forward to talking again.